Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Tyler, how are you this morning?
Good morning, Dean. I'm doing well. How about yourself?
Good. We have a special guest today. We're going to be talking about expectations for the 2018 market and talk about some of the volatility that we've seen here lately to find out if that is something that we're going to have a lot of in 2018. Or it was just an aberration. So with us today, we have Andy Osby. He is the Chief Investment Officer with Brokers Financial. And Brokers Financial is a company, and Andy puts together portfolios. He is the money manager. He puts investments into these managed accounts for independent investment advisory firms, a lot like Tyler and I have with Secure Retirement Solutions. So we use a lot of their investments. We deal with Andy on a weekly basis to find out what type of moves he's going to make in the portfolios and so on. So Andy's with us today. Andy, how are you?
Doing great. Thank you for having me on, Dean and Tyler. I appreciate it.
You bet. Andy, to get things started, we had relatively calm in the market from really the election November of 2016 all the way through January of 2018. I mean, it was a pretty significant climb in the stock market. And then just most recently here, we saw some volatility in February. And I know a lot of people really aren't used to it anymore because of that monumental climb. Is this something that you believe is going to be a new normal going forward?
Yeah, thank you. I do believe volatility is a new norm, but I do want to explain a little bit about what we think that means. And if we look at 2017 as an excellent year in the stock market with plus 20% returns on the S&P 500 alone, really you looked at a year that was pro-growth with changing policies towards the stock market. And at the end of the year, what we've seen come into play was a new tax policy that had a lot of impact on the market for January. Whenever you're going through a bull market like we've seen for the last decade, towards the back end of those bull markets or towards areas where you get a lot of run-up, like at January where we were up 5%, volatility tends to increase as you see those periods go up. It's not 1 or 2% a month return. If you're getting 4 or 5% a month return, sometimes markets view that as appreciation too fast. And I guess the new normal for 2018 is I do expect that volatility to remain probably in that 1-2% down days. I would also expect to see 1-2% up days, and generally still in a positive direction. But I do expect volatility to increase just because of the time period that we're in.
Okay. And you're talking about volatility. Tyler came into my office a couple days ago, and he had some documentation showing that, from 2011 on, we saw volatility like this a number of times per year. So, I mean, really, what we're telling a lot of our clients is, hold on, fundamentals look relatively strong, but yet we have been hearing most recently that there's maybe some concern about potential inflation. What's your read on that, Andy?
Yeah, so first part, when we look at volatility, they occur in every market cycle. Simply put, you will see 2 steps forward, 1 step back in any type of upswing or market cycle that increases valuations over time. It's hardly ever always straight up, and we experienced that really in 2017. So it was really an abnormal year more than it is the normal. Typically, you will have negative months along with positive months, and at the end, that kicks out to be a positive return for the year. And that's kind of been our history since 2008 crash that happened and into 2009. We've seen those periods of 2 steps back, 2 steps forward, 1 step back. Sorry. Mm-hmm. In the current market cycle, what we're seeing is fundamentals, economic fundamentals, are still really positive. Corporate fundamentals are still positive. A lot of corporations are still beating the earnings, which is a very positive sign as we move forward. Plus, many of them have extra cash on hand to spend to either develop. We've seen some pass those on to employees in different ways, but many different companies have extra dollars on hand for 2018 to really move forward in a positive direction. I think if we look at the past 2 weeks, and specifically what we've seen on Friday and Monday of this week, a lot of that was centered around the fear of rising interest rates. Right now, the 10-year Treasury is really close to 3%. The U.S. dollar has dropped for the last 2 weeks, and we've seen inflation concerns creep in because of interest rates rising and the cost of the dollar going down. And typically through that, you see periods of market where there is some added volatility when those things occur as you're trying to reset to the new normal. So as we've seen for the past week, end of January, beginning of February, that volatility has increased a little bit because of those worries on interest rate increases and inflation.
Yeah, and Andy, Tyler here speaking, but when you talk about interest rates, I've had a few clients say, they're in dividend stock portfolios and they otherwise wouldn't be in a different interest rate environment. And they're kind of the thought that with interest rates slowly going up, right now they're in dividend paying stocks because they can get that income through dividend yield. And now they say, well, I want to sell off if I can go into an investment like a treasury bond that I perceive as less risk, but yet I can also finally start to get a decent rate on that. Is that kind of what you're seeing with people, a portion of the market selling off of those riskier stocks and going into more, I guess, safer investments where they can actually get some yield now?
Yeah, thanks, Tyler. I would say some, and that's a broad answer, but I think really what we're seeing is for the past 5 years, a lot of clients have moved to dividend-paying stocks because they could get 3 to 4% on large-cap stocks and dividends that would pay to them that they could spend. And typically, bond yields, as we knew of them, were right around 2.5%. So they were actually earning more income on equity portfolios, dividend stocks, than they were on the bond market. I think as we move forward, what we're starting to see is that 2.5% become 3%. Still not the 3.5 to 4 that you might be able to get in dividend stocks, but it's getting closer. So I think what we've probably seen in the marketplace, on top of just general economic worries over interest rates and inflation, is an additive to your point of people saying, okay, now I can de-risk or take risk off the table a little bit and move towards fixed income. That's a double-edged sword, as we would look at it, because fixed income, as it rises, inherently prices drop, which means although yields are going up and maybe I can get 3%, it also means I'm probably losing money on the valuation of my bond. On the other side of that, there are still clients that can earn more money in the equity market. So I think we're in one of those periods where there isn't a clear answer to that, and that adds to some of the market volatility that we've seen, is that inherently people would like to take less risk to get the income they want. They're still forced maybe a little bit into that dividend income side to get the income that they desire, and there's really not a clear-cut path to move forward with as far as investing. Right now, the way that the market stands, I still think clients are paid more to take the risk of a high quality dividend paying company to take the income off of it, but bonds are getting closer.
Okay. Andy, you were talking earlier about the tax reform, and it was sort of built in, and there was a lot of momentum based on that going through and being signed into law. But there was also a lot of talk of repatriation of dollars. So some of these dollars coming back from offshore to the United States for these very large companies, that really hasn't happened yet. That's still in the pipeline. When that does happen, do you see that as a potential boost to the market again, or a non-story?
Oh, it's a boost to the market, most definitely. A couple things I always relate to when it comes to that. It is still important to mention 65% of the companies worldwide are not located in the United States. When you start to think about the global economy as we've seen it grow over the past 10 to 20 years, those companies located in the United States all have offices overseas. And the amount of money that they contain within those foreign governments, because they didn't want to bring that money back and pay the highest tax rate that was available, there is a lot of money that's available overseas that has not hit this market yet, that most likely we will see some of that come back in 2018 into 19 to invest back into the businesses, which affect the markets in a lot of ways. One, on top of the fact that these companies have more cash on hand because of lower taxes, they're going to have more cash available to spend because of that repatriation of the money. In two ways that can greatly affect in the short term what a company does. One, it'll be a lot easier for them to either increase overall dividend yield to clients or take that money and invest it back into the company so their earnings per share goes up. Either way, usually the valuation of a stock goes up over that time frame. The second way that they can do it is they can actually start building factories and businesses back in the United States from that money. If you think about some of the headlines that we've seen over the last 2 months, there are companies that are that could bring that money back to build businesses here. While that affects a company from a growing business standpoint, it also affects employees and what we can do in local economies to help boost spending, wages, and growth overall. So all of those things are really positive to the marketplace.
Good point, sir, Andy. One thing that you mentioned with the international companies, 65% of those being outside of the United States, I wanted to talk about for a little bit international and emerging market funds because, in 2017, some international funds were up upwards of 25%, and then emerging markets almost 35%. And I've had a few client conversations where they said, well, what's the outlook for 2018? If I want to add to those positions, am I too late? Are those too high? Or could I still be getting into different international funds and emerging markets? So what's your take on international and emerging markets for 2018?
For 2018. I look at it this way, and we have, and I guess a little bit of history from our portfolios from a Retirement Ally standpoint. We invested in international and emerging markets at the end of 2016, beginning of 2017, and we did it in the portfolios in a moderate way. We didn't over-aggressively invest into them, but we definitely added position to the account. And the reason why we did it at that time is because the global economy looked good. Still does look good, so I don't want to make it past tense, but as we added them, it looked good from a global economy. It still looks good for this reason, and I guess this is where I would come at it and say for anybody looking to invest in global markets, international or emerging markets, I think it's still a good time to invest because from an international standpoint just alone, total international large cap companies, we are still not in the market to the levels that we were at in 2007 and mid-2008 before the sell-off. So currently, where the price is for international large-cap companies, we're still at a discount to the 2007-2008 timeframe. When it comes to emerging markets, we're about equal. As a picture, once again, large-cap internationals below where we were in 2007, and emerging markets about equal to where we were in 2007. As a corresponding reference, in 2007-2008, our last market crash, the S&P 500 was roughly, as far as a price of an investment, IVV, iShares Core S&P 500, was at about $144 a share. As it currently trades today, or as it closed yesterday, we were at $270 a share, $272 a share. So just in picture, what we've seen happen in the U.S. is really about a doubling of that price from a 2007 standpoint, which were market highs before the sell-off, Internationally and emerging markets are still at or below those targets. So I think it's still a good time to invest internationally. Last year was a really good year because it's starting to catch up as the global economy recovers. The one risk when it comes to international is don't overweight it, because you tend to have more risk internationally than you do domestically, such as an S&P 500 or Dow Jones as we know them. But I think the opportunity still exists to be there.
Okay, good point. Andy, we're going to take a quick break here, and then we'll come back and talk about whether investors should take some of their gains off the table.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back. We're going to talk about gains. We started the show here talking about how 2017 was a wonderful year. We ran into some volatility early in 2018. But Andy, I hear from some of our clients, they'll say, well, should I be taking money off the table because of the volatility? Well, actually, before we answer that, I want to know, should people be taking some of the money off the table or looking at just rebalancing in the basic premise their gains that they had in 2017?
Yeah, thanks, Dean. And I look at that in two different ways. I think it's always something that's in the client's best interest to rebalance portfolios during the year, which inherently is taking off gains in the portfolio. In 2017, we've seen incredible increases in the equity markets. So portfolios are probably at this point a little heavy on the equity side based on that increase. And what tends to happen is during corrective market cycles like we've had for the last 10 days, really you're in a period where if you were allocated appropriately to a client's risk tolerance, the actual amount of loss from previous highs would have been less had you rebalanced. So I think it is always a good idea to rebalance overall positions and look at it from either taking gains off the table or resetting what that expectation is for returns. Because if we look at it that way, as down markets happen, I'm taking some of my gains off the table as I go along, so my losses aren't as big in a period where a market might drop off.
Good point there, Andy. One question that I got asked a lot in 2017 when the market was doing so well, there might be a client that they grade it out as a moderate portfolio. We always have them take their risk questionnaire, and they may have graded out as moderate, and they ask, why do I still have bonds in here in 2017 when the market's doing so well? Can't I go heavier into stocks when the market is doing well? And my response was, the market isn't always going to do well, hence what we just saw in the last 10 days. So if you could just explain for our listeners what the main reason is for keeping bonds in a portfolio during times of volatility.
Sure. As we look at overall portfolios and using the moderate example that you had, most moderate portfolios are going to contain about 60% equities and 40% bonds. How those portfolios are invested differs a lot to investment manager, what they're looking at, what they buy into in either the bond or equity categories. I would say it's a familiar question to what I received over 2017 is, why do we have the fixed income there? Why don't we just move the equity position up to 80% and subtract out some of the fixed income? The short answer is because adding equity increases risk. If we look at 2018 so far, and Tyler, as you mentioned, it's a really good example of what that can possibly mean, is that if you increase your equity exposure, January would have been a really good month. I mean, you could have picked up another 1% to 2% return just in January. The issue with that is over the course of 2 days, you probably would have lost double that.
Yep.
So as you think about overall risk tolerance, just in general, we try to set tolerances for what the client will expect during an investment life cycle. 2017 being a really good year, typically, as we mentioned earlier, you do see that 2 steps forward, 1 step back type of market over time. And the more we can protect on the downside of a market, the less we have to make on the upside to actually outperform over time. A great example that I tend to give is if your market makes 10% and you only make 8 because we had 20% fixed income, assuming it made 0, if you had 100,000 to begin with and you made 10,000 in the market, you would have had 110,000. If we only made 8, we had 108. Yes, we lost, and we could have invested in more equities and picked up that extra $2,000. But if the very next year the market loses 10,000, your 110,000, you loses 10%. That 110,000 you have is now worth 99. If you have the 108 and we can moderate that loss, we can have over $100,000 and we actually win. So really, we try to look at it as in a full market cycle for what we have. To the fixed income side, a lot of what we try to do there is just not buy general bonds. You do have to have a certain portion of the portfolio invested in cash bonds as we see them, treasuries, corporates, because in a down market cycle like 2008, those types of investments may have lost 5 to 10%, while the equity markets lost 50. So they really act as a cushion to a portfolio to try to protect downside losses. For a client that wants to swing with the market, they should probably just look at an aggressive position, but you have to pick a path forward. Do you want to manage risk, or do you want to go all in and invest in everything? What we try to do in the fixed income arena is, in the moderate example, is we may use 20% as a standard cushion to a portfolio, which in 2017 provided about 2 or 3% return versus the S&P 500. The other 20% we moderate based on current market conditions. So that could be adding things that have higher dividend yields, can get us extra returns than the normal bond market. We really try to be active in those portfolios to add value to an end client as they look at it. And I think most importantly, if we think through that just from a client standpoint, that first part of picking the model and where they're at really sets expectations for going forward and how the market will react going backwards. So I think it's a very important process. The fixed income part of it, some of it acts as a buffer, some of it acts as an additive performance based on how we invest it, but I think it's very important to the overall portfolio.
Okay, Andy, good points. I was looking at some numbers this morning. You know, we saw here in February a bit of a sell-off Friday, Monday of this week, and I was looking at numbers, seeing if there's any trends, and I did pick something up here that I thought was quite interesting. It seems to be that large cap and mid cap suffered more than small cap, and typically, don't we usually see small cap show more volatility? Can you give us any heads up or what you might think why the small cap was more stable than the large and mid cap with this bit of a sell-off in February?
Yeah, thanks, Dean. And I would probably say what we've seen from a sell-off in February is internationals and emerging markets were actually worse than large caps, and then mid cap, and then small cap. Some of that is just due to what happened in January. In January, the highest returns were in international and emerging markets, then large cap, then mid cap, then small cap. So if we were to rank them just in a January standpoint, we've seen internationals return 7-8%. We saw large caps make 5.5. We saw mid caps up 4 and small caps up 2.5. So they had less to correct from the run up in January. I think is a very important first step of that. The second step is typically small caps are the first things that make money in an economic recovery. We are not in that stage, but if we think about how a tax reform can help individual clients, most small cap companies were probably in a tax rate of 39% in 2017. Those companies now have a pass-through down to 21, 22% that they can use. That money for them is more active in a current term for that market than what it is maybe for a large cap. Even though they have more money off of a tax bill, it may not hit them until this summer or fall.
Good take there, Andy. As we wind down here the last few minutes, I know you touched on it earlier, but I just wanted to ask you, do company fundamentals and the economy, does it look good in your opinion, and what's your take just on the 2018 market outlook in general?
Sure. Thank you, Tyler. I look at the 2018 market as still positive. the general things that you would look at, such as unemployment, durable goods orders, overall profitability for corporations, and general market sentiment are all still positive. So market indicators would lead me down the path of 2018 still being a positive year. At the same point, I think we've experienced in the last couple of weeks a new reality of, we knew interest rates were rising. It happened 3 or 4 times in 2017. I would guess we're going to see 3 interest rate increases from the Fed in 2018. Some of the paranoia of the markets today is they're actually thinking there could be an extra 1 or 2 on top of the 3. And that interest rate uptick and the dollar downtick has the market a little unstable at the current time. If I look at 2018 on the backdrop of economics, current market condition, and what we would expect, I still think the market's in a generally positive direction. I still think there will be returns this year. Maybe it probably will not be a 2017 as far as returns, but an S&P 500 that's up 21% is not normal either. An average market return in the S&P over its history is somewhere around 9-10%. I would call this year probably more of an average year, but still positive. I do expect periods of volatility as it comes up. Volatility meaning 1 or 2% corrections at different random times, and that's probably something to get used to in the market this year. On top of that, I would say headlines or just what we read and gets put out will probably be troublesome over the course of 2018. A good example of that is on Monday, we've seen the biggest market loss ever. And I think it's important to note the reason why it's the biggest market loss ever is because we're at the highest point of the market ever. So a correction of 3 or 4% in a day, which has happened many times over our history, is now worth more than what it used to be. So summarizing that, I do still feel the market is in an upward trend. Economics still look positive. I do expect to have more periods of what we've experienced over the last 10 days for the year. I do not expect or see a recession that would be out there. I still see that positive market uptick. I just think the new normal will be more negative days than what we've seen maybe in 2017, and correction back to probably an average type of year in the marketplace.
Good information. Andy, we're coming to a close here. Great job. Good information. I'm sure our listeners are going to appreciate that. This is on air with us, Andy Osby, Chief Investment Officer with Brokers Financial. That's all the time we have this week, folks. Take care, and we'll see you again next week.
Thank you, Andy. We'll see you next week, folks.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.